Good afternoon, everyone. My name is Liz Ritchie and I'm Head of Tax here at Mazars. Thank you for joining us this afternoon for our commentary on Jeremy Hunt's autumn statement yesterday. So yesterday, the Chancellor promised a raft of measures to enhance growth. As always, speculation has been rife on the possible measures that might be included in his statement. As we've seen over the last few budget statements, there was so much speculation in relation to inheritance tax. At one stage it was going, then it was staying, but at a lower rate. There was also commentary around stamp duty land tax. Was it going to be cut to stimulate the housing market? And would the full expensing relief introduced very recently on plant and machinery investment be made permanent? Well, in fact, only one of those proved to be correct. The speculation on National Insurance Contribitions really only just started in the last few days. So this was the real rabbit out of the hat yesterday. So I'm joined today by a number of my colleagues just to share their comments and views on the statement yesterday. So first of all, we've got George Ligarius, who is our Chief Economist. We've then got Sean Coburn, who's a director in our private client team. Ian Goodwin, a partner in our employment taxes team, and Pooja Joshi, who is a director in the corporate tax advisory team. So a little bit of housekeeping before we start, and I hopefully will get this correct. If I can ask those of you who are joining on Zoom to use the Q&A box to post any questions that you might have for our panelists, and we'll answer those questions at the end of the discussion. There's quite a lot of time left over for questions at the end, so please, I encourage you to send through your questions. If you're joining us on LinkedIn, please use the comment section. So we're recording the session, and the recording will be made available to you afterwards on the website. And for those of you who've joined us on Zoom, that will be via email. And we welcome you, happy for you to share that with your colleagues. So I'm now going to hand over to Chris Ridley, who is a director in our Innovation Incentives team, and he's going to chair, he's going to manage the participants for the rest of this discussion, and he will pose the questions going forward. So over to you, Chris.
Thank you very much, Liz, and good afternoon, everyone. To kick things off, let's start with George Ligarius, our Chief Economist, who will give his update on yesterday's announcements. Over to you, George.
Thank you very much, Chris. Hi, everyone. My name is George Ligarius. I'm the Chief Economist at Mazars, part of the team that manages client wealth. So there are two takeaways from yesterday. The one is the stimulation, the economic stimulation from tax cuts and other measures that are supposed to help investment in manufacturing. So on the one hand, you have this. On the other hand, you have an economic slowdown, which is projected to accelerate as per the OBR. Of course, the reality is that markets have already forecasted this some time ago. Let's start with the latter. The economy is projected to grow by 0.7% next year, according to the OBR. Already consensus has it half that, 0.4%. And similar to that, we also have next year, where generally growth is supposed to be a little bit higher than zero. So what we have is roughly 2.5, 3 years of near zero growth. And this is definitely a big takeaway. Add to this consistent deficits. Presently, the deficit runs around 6.5%. That means that the UK is actually borrowing to maintain an even keel, just to stay above the recession line. And it's borrowing in terms of GDP nearly as much as America, who, however, see a 2.5% growth. So on the one hand, what we see is slow growth. Inflation is coming down. In the UK, slightly belated, not slower than everyone else, just slightly belated, and that is probably because of how tight the labor market is in the UK. By the way, apologies for my voice; it's not usually that masculine. So the inflation presently is at 4.7%. It's projected to be around 4.5 by year's end, 2.5 by the end of the next year, and maybe a 2% going forward after that. So sort of good news on inflation, bad news for growth. What does this government do? They come in and they try to say, okay, growth is slowing, what shall we stimulate? And they focus, because obviously they're already borrowing so much, they can't just stimulate everything. So tax cuts for some of the weaker cohorts, that makes sense. The lower you go to the income base, the broader the base is if you stimulate it. Okay, the more marginal consumers. So for example, if you stimulate somebody who has, let's say, £1 billion worth of fortune, and you stimulate them, that will probably become more investments. It will not become more direct spending. But if you stimulate the base, then spending is more broad-based. So they try to stimulate by doing some tax cuts to certain key economic cohorts. And they're taking measures such as 4.5 billion to spend to stimulate manufacturing investment, and the full and maintaining the full expensing project. Now, these are good, and I think they're going to help growth. I think that overall, this moves this gives more points to the positive scenario, higher probability to the positive scenario that we will not see 0% growth, that we could see something a little bit higher than that. Having said that, with more growth comes more inflation. Okay, so projections for inflation around 2.5% could end with inflation at 3%. So that begets the question, okay, if because of that we get higher inflation, what does this do for rates? Well, presently the rate outlook is for cuts near the end of the next year. But obviously, if there's an uptick to growth, if there's a positive surprise to growth, then you should expect rate cuts to delay as well. Okay, so because that's what the central bank does. It tries to maintain an even keel. Okay, now will they defer rate cuts if we're still growing under 1%? I don't know. Okay, it depends on how hot the inflation is coming, because that's their primary mandate. Now, just a few more comments, and then we can catch up again during Q&A. It's one thing to look at our UK microcosm, but generally speaking, we should look at the international environment as well, which is one of slower growth altogether. US, EU, a lot of that in the EU. Germany especially has a problem because they can't stimulate, they had a court order where they can't use COVID money to stimulate the economy again, and they're in a bind. And also the Chinese have figured out how to make cars better than the Germans, and that is hurting their economy. Plus, they do a lot of quantitative tightening. They remove money from the market. The ECB does. And our next door neighbor is the EU, so that European slower growth is definitely going to impact the UK. And the US is slowing down as well. It's stimulating, but still slowing down next year. So the overall economic environment is definitely one of slower growth. What I would watch for in this environment, number one, I would watch for high debt levels, because it doesn't show because we're not growing as fast, but we are borrowing a lot of money. Okay, by the way, as a caveat, I am Greek, so I speak with some authority in what happens if you borrow a lot. I ended up a migrant in the UK. So that's number one. Number two, um, I think there is an element here that's missing, and it's the bull market. In case the central bank prioritizes growth, that means that rates are going to come down, and that could mean very good news for stocks, bonds, investments, and what have you. And I know you care more about your business and your, your real economy, but actually, if stock markets are up, then that tends to favor the economy as well. We tend to see more foreign investment and what have you. Okay, cheaper money is the key to unlocking growth. It's just a question of when the central bank will feel that inflation has been beat. And you can stimulate the economy all you want, but at the end of the day, if inflation is beat and the central bank stops choking economic growth to mitigate inflation, then we're going to see the next leg up for growth.
Brilliant. Thank you very much, George. And as always, very, very insightful in terms of what the impacts might have on the economy. You mentioned in part of your discussions around the impact that has on individuals and the fact that some of the announcements were having an impact on a wide number of individuals. I'll turn now to you, Sean, to give an impact or an update on the impacts to individuals of yesterday's announcements.
Yeah, thank you, Chris, and good afternoon, everyone. My name is Sean Coburn, and I work in the private client team here at Mazars. So yeah, lots of rumours in the run-up to the autumn statement, and as seems to be the case these days, a lot of them turned out to be quite accurate. The Chancellor, when he stood up, spoke about focusing on growth and wanting to reward workers for this. For self-employed individuals, this took the form of a simplification and a reduction in their national insurance contributions. Mr. Hunt abolished the weekly Class 2 national insurance contributions and also applied a 1% reduction to the Class 4 rate, so reducing that from 9% to 8%, and that's paid on profits between the personal allowance, currently set at 12,570, and the higher rate threshold down in the rest of the UK, set at £50,270. The combined effect of this is a maximum national insurance saving of about £560 per year. And this will affect approximately 2 million people. It's effective from April 6th next year. And because it's national insurance, it will apply UK-wide. So it's a very welcome reduction in the overall tax burden for self-employed individual. One thing it will do is it will close the gap on the tax benefit of running a business through a company. So perhaps we'll see less tax motivated incorporation of business with a structure for the business probably more likely driven by commercial factors rather than tax motivations. And of course, it's not just the self-employed individuals who saw a reduction in their national insurance. Probably the headline announcement was a reduction in the NIC rate for employees, and Ian Goodwin from our employment taxes team will take a deep dive into that in a few minutes' time.
Brilliant. So a reduction in national insurance is a good thing. Will workers expect to pay less going forwards now?
Well, yes, and no. There will be a near immediate reduction in the NIC burden that workers, I'll call them, suffer in the UK, but income tax rates and thresholds, they remain unchanged. The statement was actually silent on these, with the government having previously said that the existing rates and thresholds were going to be remain unchanged until April 2028. Similarly, if you consider the high income child benefit charge, so that's the limit at which individuals can earn before they start having to repay child benefit, that remains at £50,000 for the high earner of the couple. Now, this amount was introduced 10 years ago, and it's not changed over that period. And meanwhile, we've seen increases in salaries trying to keep pace with inflation. The Chancellor has maintained the triple lock pension increase, so we see an 8.5% increase in the state pension. There's been a sharp rise in both rental income and interest receipts. So on a purely numerical basis, income has gone up. And with rates and bands staying static, all of this creates what we call fiscal drag. So this is where the failure of tax rates and bands, tax rates and bands fail to keep track with the growth in income, and the consequence of that is it means more and more taxpayers are dragged into a higher tax bracket than they were previously. Critics often refer to this as stealth tax. So yeah, whilst the NIC cuts will offer some relief from the historically high tax rates that we're currently seeing, people are likely to find that over time, a larger proportion of their income is going to be eaten up by taxes. And of course, we can't forget some of the previous announcements that are still to come into effect in the autumn statement. Last year, we were informed of the reduction in the dividend allowance. So last April, that reduced from £2,000 to £1,000. And then come April this year, that's going to reduce again to just £500 per annum. And similarly, this April, we're expecting the capital gains annual exemption rate, so the amount of gains that an individual can create during the year before paying tax, to again half to just £3,000.
So it doesn't sound, Sean, as though it's quite as generous as you might first think in terms of the national insurance reduction. Do we know why the Chancellor chose to reduce national insurance rates rather than potentially change income tax rates or bandings?
No is the short answer. We don't know, but I'm always happy to speculate. We know the Chancellor wanted to reward workers, and so when he was considering that, his options were probably limited to simply income tax or national insurance contributions in the first place. Looking at these, he might have opted for national insurance because for starters, it's cheaper to reduce the NIC rate than the income tax rate because, of course, national insurance contributions do not apply to non-earned income, they don't apply to pension income, and they don't apply to individuals over state pension age. And perhaps it was also with a view to appeasing Scottish voters because and looking to avoid further divergence in tax rates between Scotland and the rest of the UK, since national insurance does apply UK-wide. If he had simply opted to reduce income tax rates, that would only have applied south of the border, and he would have required the Scottish government to reduce a similar reduction to see Scottish taxpayers vote, and that seems unlikely given some of the recent statements coming from the SNP.
Okay, thank you, Sean. And the Chancellor, as far as I'm aware, also announced that he would like to reform the way employees save for their retirement. Could you elaborate on that for me?
A little bit. He announced the concept of a pension for life for employees. So this is taking inspiration from some other jurisdictions. I think Australia was mentioned, and it's a structure that effectively is a pension pot that follows employees around throughout their career. So if the current structure is probably an individual, I think I saw, has an average of 11 jobs throughout their career. Now, if each of those jobs created a pension pot, you can imagine at the end of the day, he's going to have 11 pension pots, which will be quite a nightmare to administer. The concept which applies in and is being considered here is that there is a single pension pot that follows the individual around throughout their employments, and then the employer is required to contribute to that single pension pot. And from an individual's perspective, there's absolutely obvious benefits to that, in particular in terms of administration, but there's probably also the benefit in terms of economies of scale. Having all your funds in one place probably will lead to an overall reduction in costs. However, from a employer's perspective, it's potentially a huge burden if, for instance, you imagine an employer with a large number of employees having to deal with any number of pension schemes and pension providers. You can see how the burden would stack up quickly. So as it stands, it's currently just a concept to be considered further. Be interesting to see where that goes at the end of the day. And the other thing on pensions is we actually received some helpful news as well, if not comprehensive guidance around what happens to pensions for those who pass away before they reach the age of 75. And this is a throwback to the announcements and the reforms announced in March, where the government abolished the lifetime allowance. At that time, there was some concern about the tax implications for individuals who died before reaching 75 and what that meant for the beneficiaries. And based on the guidance at the time, it looked as if the only way that the pension fund could maintain its tax protected status was if it was drawn down as a single lump sum, and that obviously has implications. For instance, pulling the entire pension fund into the individual's estate, which would create inheritance tax implications, if nothing else. There was further guidance issued yesterday that suggests that actually those pensions will also benefit from the existing tax protections. As I say, it wasn't 100% clear, so we do await further clarity, but hopefully it's a sign that one of the main concerns that was thrown up from those March reforms is being addressed.
Okay, so definitely more things to come on pensions in the future. And did I not read somewhere before the autumn statement that there's potential changes to inheritance tax? Where did those go?
Yeah, you probably did. As Liz mentioned, there was some speculation around reforms to the inheritance tax rate, or even the abolition. So this is the inheritance tax is the tax that applies to an individual's estate, in particular when they pass away, in excess of the nil rate band. In the end, nothing was announced. Again, for inheritance tax purposes, the nil rate band is frozen at £325,000, and we're informed that will be the case until 2028. So again, this fiscal drag concept comes into effect as asset values increase. More and more people will be pulled into the scope of inheritance tax. People will want to start considering that, in particular when they're looking at lifetime giving, or how to structure their estates when looking to pass wealth down to the next generation. So yeah, nothing announced on that front, and that probably covers everything affecting individuals in the autumn statement.
That's great, thanks, Sean. Ian, can I now turn to you to give an update on the impact for employees?
Thank you, Chris, and yeah, great to join everyone today. There was, I suppose, two big announcements. That one came out the day before the autumn statement. They always like to leak a few things out beforehand. And one came out during the autumn statement. It was a little bit of a surprise, really. The first one was related to national minimum wage, a £1, 2 pence, 9.8% increase, and also a reduction in the age limit for the national living wage. So it's going up to £11.44 from April, from £10.42, and it will apply to everyone 21 and over rather than 23 and over. And we then had the news yesterday about the employee national insurance reduction by 2 percentage points, from 12% all the way down to 10%, and that will come in play from January. So payroll teams will be stretching themselves to get that done, and I know that will be a big task for some people to get that done within 6 weeks.
Brilliant, and thanks, Ian. And what does that mean for pay overall?
Well, there's a few things here. I suppose you've got to look at both the employee and the employer. From an employee perspective, someone on national minimum wage now is going to see, and say they're working 40 hours a week, 52 weeks a year, let's say, then they're going to see about a £1.5 pay increase, as well as an extra £150 being put into their pension. So actually, that's a good news story there. They're going to have more money to pay bills and do things with in that respect, especially as we're hearing the news today that energy prices are expected to rise by another 5% in January. So people are going to have to afford those, and this will be obviously beneficial for that. For individuals who are above the minimum wage, they're going to see an increase because the national insurance will reduce. Now, someone who's earning, say, £25,000 a year, they're probably going to save somewhere around £250 a year by this announcement. Someone who's earning well above the threshold, the £50,000 threshold, for the upper rate of national insurance when they start paying at 2%, will probably be about £750 in savings for national insurance there. So they're not small sums, but they are restricted to the national insurance there. And obviously there's going to be other things that might interject. And like Sean pointed out, we've got a freezing of personal allowances, a freezing of those thresholds that you would typically see increasing. So that's going to restrict some of those, particularly if we're still going to see energy prices and other prices rising as well. So from an employee perspective, some good news there. From an employer perspective, a very different story, I would say. They've got increased costs to fund this pay increase for those on or around national minimum wage. It's a massive increase in some respects, because you may have some people that pay at minimum wage at the moment and pay people another 50p more. Well, actually, they're going to have to increase both those salaries to the £11.44 amount now. So there will be some interaction with pay differentials. I think from our workings, we saw that it was around an extra £2,500 extra in cost for the employer to pay for someone who's a full-time worker on national minimum wage, including obviously the additional pension contributions that brings. That's not to mention any other costs that might be related to increased life assurance or other things that are linked to pay in that respect, i.e. overtime, etc. So there's other things that employers are going to have to factor in. Where you have 50 employees that are on minimum wage, that's going to cost an extra £10,000 a month, £125,000 a year. So the employer is really going to have to think about, how do we fund this, and how potentially do we differentiate pay for people at different levels in the organisation too, given that those are going to get eroded as well.
Thanks, Ian. It sounds like good news for employees and things to consider from an employer's perspective to try and differentiate themselves. There was more than just national minimum wage, though, wasn't there?
There was. I mean, you had obviously the national insurance was a big piece there, and I think just to labour on the national minimum wage, because it links into one of the other subtle announcements Jeremy Hunt made during the speech, which was that it's going to make sure that everyone pays the right amount of tax. Now, that means they are going to be investing in HMRC to investigate and make sure people are being compliant and have got robust governance in place. So organisations are going to have to make sure they are addressing that. They are not taking risks. They are acting carefully and with due diligence, particularly if they're coming up to a transaction, because that's going to come out in the wash. You know, from my perspective, I'm seeing HMRC really focusing on IR35 and national minimum wage at the moment. So I really do implore organisations to think about those things, as well as their wider tax affairs at the moment, given that we're going to probably see HMRC back out in force more over the next 12 months and beyond in that respect. Linked to that, we had two smaller announcements from an employment tax and reward piece. We had, I suppose, an easement to some degree from an IR35 off payroll working regulations perspective. It had already been kind of announced, particularly on social media, that where you have, I suppose, been challenged successfully by HMRC during an off payroll working review, and they've deemed that off payroll worker to actually be an employee, and there's pay as you earn a NIC to apply, they will allow an offset for the taxes paid to date. So that will come into force from April 24, but it's already kind of being used in practice, I would say, by HMRC. Separately, for those in the construction industry, there's going to be more scrutiny on that, and they are looking at, you know, what you should be doing and how you need to manage your tax affairs to maintain your gross payment status, with VAT compliance added to that as well. So there's a few things to definitely think about there. And for me, that obviously the big story is the national insurance piece, the national minimum wage piece, and there's I suppose a tale of two cities in relation to certain employees on one side, the employer on the other. But then you've got the employees in the middle who will benefit a little bit from the national insurance saving, but might have a little bit, you know, is it going to be right for them because they're not going to be paid they might not be able to be paid anymore by their employer. So they'll see an erosion on that pay differential, and that might cause the employer some instances of recruitment and retention issues to think about, well, and what do we do to actually maintain and retain that individual? Do we give them something non-cash? Do we look at our benefit structure? Do we think about pension we offer and how salary sacrifice might interact with that? There's lots of opportunities to think about things, but you really need to know what your workforce wants and know what you can afford to pay as well, given otherwise, you know, there may be, you know, things to think about from how you kind of, I suppose, make your workforce more efficient and effective going forward as well.
Perfect, Ian. It definitely was the national insurance reductions that made the headlines yesterday. So that's great, and thank you very much for the update from an employee perspective. Pooja, can I turn to you now to give an update on the business taxes, as I'm sure everyone on the call would like to have an update on that regard.
Thanks, Chris. And yes, of course, good afternoon, everyone. I'm Pooja and I work in the corporate tax advisory team here at Mazars. So from a corporate tax perspective, full expensing has been made permanent, as we know. It replaced the 130% super deduction and was due to come to an end by 31st of March 26. But the Chancellor confirmed yesterday that it will remain intact permanently. So what is full expensing? Well, it's an uncapped 100% fair share allowance for most tangible assets used in the ordinary course of business. So these are things such as machinery, your office equipment, warehousing or construction equipment, and certain vehicles too. A similar 50% fair share allowance is available for special rate assets. So these are items that are typically integral to buildings such as lighting and heating systems. So making full expensing permanent does provide companies with certainty of tax allowances on their capital expenditure. The temporary nature of previous capital allowance windows created a series of cliff edges, and they weren't available for a long enough period to really stimulate investment in major capital projects. And even with a general election looming, there does seem to be political consensus around stimulating investment-led growth. So this is unlikely to be something that's reversed anytime soon. But a couple of points that are more practical for our audience to take away today on these full expensing changes. Firstly, the impact it'll have on deferred tax. So the acceleration of capital allowances in recent years is creating deferred tax liabilities on balance sheets, because assets are depreciated at a slower pace through statutory accounts. And it's just something to be mindful of when considering what your balance sheet might look like. Secondly, large businesses, they do need to assess the implications of claiming these allowances and the impact this will have on the rate of UK tax paid within the Pillar 2 compliance obligations. And thirdly, and I think we've seen this impact a few businesses, is where businesses might have a group where their properties and assets sit in one company, but the trading takes place in a different company. And these properties and assets are then leased or hired by the trading company from that asset company within the group. These assets are not going to qualify for full expensing in the way in which the legislation is currently drafted. So leased assets are specifically excluded in the legislation, and the definition of leasing is widely drawn. So it captures a broad spectrum of scenarios, including where assets are leased intra-group, even if it's all within the UK. It seems a little unfair, but there is a working group that's been set up to look into this. The annual investment allowance can be used instead in this scenario, but yeah, it's just one to be mindful of.
It does sound very much like this full expensing is one welcomed by the business community, just giving certainty about going forwards, Pooja. So that's really good to hear from a business perspective by the sounds of things.
Yeah, definitely.
What about R&D? Is there anything our audience should be aware of that changes may be announced yesterday?
Yeah, so I have seen a few questions come through today on R&D, and so the major R&D announcement is that the SME and RDEC scheme will form a merged scheme from 1st of April 2024. So the changes that have already taken place, so from 1st of April 2023, which is the decrease in the SME relief to 86% for profitable companies from the 130%, and an increase in the RDEC credit for larger companies are still in effect for now. And these changes were driven at the time by a concern, and I think that concern still exists, that the SME scheme has been abused historically and needed addressing, but also to encourage larger corporates to really invest more in innovation. And I think, the cost of borrowing impacts that, but, we're really this is really being encouraged here in the announcements yesterday. In practice, we've seen a delay in repayments, so R&D repayments being issued, and certainly more scrutiny of R&D claims. It is worth speaking to a professional advisor who can analyse and review the eligibility of this expenditure upfront and on a timely basis.
Thanks, Pooja. And we mentioned about the merge scheme at the start there. Can you give us some more details around what the merge scheme would entail?
Yeah, absolutely. So good question. So HMRC have issued some initial guidance on how this will work, but there is some detail lacking at this stage. What we are clear on is that the current proposal is to implement the new scheme at the current RDEC rate of 20%, and the notional rate applied to loss makers will be reduced to 19% rather than the current rate, which is 25%. The company that makes a decision to undertake the R&D will also now be able to claim the RDEC relief. The main impact being there to enable larger companies who would have been unable to claim under the existing RDEC scheme to claim relief for subcontracted R&D, and for subcontractors to have clarity as to what they can and cannot claim. Another point that's coming into effect is the subsidised expenditure rules will no longer apply under this merged scheme. So this will mean, for example, if there's a receipt of a grant for a project or where the cost of the project might be funded by a third party, it won't prevent the company from claiming relief for the gross expenditure on the project. It's also expected to include more generous PAYE and the NIC cap from the SME R&D scheme, but it will restrict relief for overseas R&D expenditure. So this will mean, for example, software developers and similar R&D contractors will usually need to be onshore in the UK to benefit from this scheme. Finally, loss-making R&D intensive SMEs will continue to benefit from the SME tax credit at a rate of 14.5% instead of the 10%. And an R&D intensive company is being defined as one where 30% of its total expenditure is incurred on qualifying R&D activity, as opposed to 40%, which it was. So that's become a little bit more lenient. It's likely to impact startup companies, particularly in the technology and life sciences sector. But I guess the top tip to take away for SMEs making R&D claims is that, yes, the relief they're getting on R&D is going to reduce further from 1st of April 2024 under this merged scheme. And if there is any planned R&D already in place, it may be worth bringing it forward, if possible, to benefit from the current SME rates of relief.
Yeah, thanks, Pooja. It definitely sounds like it's a good news story for large businesses, but
Yes.
more bad news for smaller businesses in that area. So we watch this space as we go forward. And finally, is there anything else that you would like to speak to our audience about today in relation to business perspective that was announced yesterday? Maybe things that didn't quite hit the headlines, but things that were in more of the detail of what was announced.
Yeah, and no, and that's a good question. So what we haven't mentioned are recent VAT changes. So the government recently announced that EU legislation may be used to assist with the interpretation of VAT law, but nothing in EU law can disapply UK VAT legislation. So this has changed because it changes the ability to cherry pick between EU and UK VAT legislation. And this did previously take place to find tax efficient VAT solutions in this transitionary period post-Brexit. But I think if there are queries on this, please do speak to your usual Mazars VAT contact. We have seen it have more of an impact on businesses in financial services and insurance, as well as property. Just very quickly for very large, and I guess also I'll touch on SME businesses as well, but for very large businesses, and by very large, we mean those with a global turnover of more than 750 million euros, the under-tax profits rule was announced, which means HMRC can charge UK companies a top-up tax on the profits of any group members in low-tax jurisdictions. So even where the UK company is not necessarily the parent company. This could impact US headquartered groups because the US still hasn't adopted Pillar 2. And the way in which that works is to apply a minimum tax of 15% in each operating jurisdiction of a group. So guidance on this was released in July 23, and the impact of these changes will not be a surprise to those already in the process of analysing these rules for their business. Just quickly touching on SMEs, I mean, businesses are getting squeezed from all sides here with the R&D. Are they really going to spend that much on capital expenditure? And, you know, they're getting hit by the higher CT rate hike and also rising costs and wages. I did mention earlier, bring forward planned R&D investments where possible, but also, I guess, any businesses, large or SME, exploring the green tech green tech sector could benefit from the funding announced towards net zero. So a nearly £1 billion accelerator fund was introduced to target areas such as carbon capture, hydrogen and offshore wind, and it's expected to be available from 2025. But it is worth exploring the availability of grants as well as tax breaks for SME businesses in this area. But just lastly, from a practical perspective, what I'd advise businesses to do is to think sustainability, think about investments, do speak to your tax contact and seek proactive sector and site-specific guidance. But yeah, thanks, Chris. That's all from me for now.
Brilliant. Thank you, Pooja, and thank you to all of our panelists in covering their different sections. And thank you to everyone as well that has been flooding us with questions as we've gone through as the panelists have been speaking. So we'll come to as many of those as we can shortly. Just in the meantime, I'd like to just come back to George, if that's okay, George, and just to ask you from an economic perspective what we might be seeing next in the future.
Yeah, so I don't want to hog the spotlight because I see a lot of questions. So number one, interest rates. Expect them to go down later next year. Expect unemployment to tick up just a little bit because the labor market is tight. Expect growth to be flat or slightly better than flat. Yes, there is a possibility of a recession, but I think that's now less of a 50% probability, at least a prolonged or deep recession. I don't think that's the base case. So expect these.
Brilliant, George. Thank you ever so much. That's really, really useful. So I think, as you said, George, and alluded to, we have had a number of questions come through. So thank you to everyone for asking those questions. I think I'll start with a question for you, Sean, if that's okay. And I think just before Sean comes on camera, can I ask all the panelists to come on camera now, just so that I can see them all and I can know who to pick the next question on as they're on screen. So Sean, coming to you first. And one of the questions that we've received is it still generally best for owner-managed business directors or owners of businesses to pay themselves via a dividend salary combination?
Well, I guess from a purely tax efficiency perspective, they would probably want to pay themselves a salary sufficient to protect their state pension entitlement, and dividends beyond that. But there's other things to consider there. They'll need to consider whether they actually need to pay a higher salary to cover their directors' duties, and also whether the national minimum wage will apply as well. And then from a wider commercial perspective, you don't have to remember too long ago to see the impact of COVID, and what we saw during that time is that a lot of the support, the furlough payments, were actually based on salaries, earned income, and so a lot of individuals who had largely remunerated themselves by way of dividend, they didn't receive the same level of support. So we see a lot of our clients taking that into account when they're considering their remuneration structuring these days. So again, it's a yes and no. Certainly not a one-size-fits-all answer for that, Chris.
Perfect, and thank you very much, Sean, for that response. George, just one turning to you around sort of the economy and interest rates. How robust are interest rate forecasts currently?
Not at all. The market is very bad at forecasting interest rates. And quite frankly, inflation is not something that we can forecast or understand very easily. It's impacted by a lot of factors. So whatever you hear in terms of forecasting, especially around interest rates and inflation, take them with a bucket of salt.
Perfect. Short and sweet, George. Thank you ever so much. And one coming to you, Ian, from an employee perspective. One of the questions is, what impact will the reduction in employees' national insurance have on the timing of bonus payments? In particular, they're asking whether bonus payments should be postponed potentially until after the 6th of January.
It's a good question, one we thought about yesterday a little bit after the announcement. You've got to remember that national insurance for the majority of people, unless you're an office holder, is on a pay period by pay period basis. So you'll be looking at how much you actually earn in that specific month. Now, a lot of people will probably pay bonuses in December. Say it's £1,000 bonus, that's potentially £20 extra. But if they go above the upper earnings limit, i.e. it takes them, I think, above £4,189, then it's going to be at 2%. So actually, you've got to look at your workforce here and think, is it actually a good thing to do? Obviously, for the employee, getting anything extra probably is going to be helpful. And you'll have to think, well, can we actually defer the bonus now? Is that a good thing to do? Have we passed that time when entitlement is due on the bonus as well from a tax perspective? If you've already issued them or you're about to issue them, it may be too late. If there's obviously still some discretion, it might be something to look at. But how would that then impact with what employees are expecting before Christmas to pay for Christmas, etc.? And would it be better to look at something else you can do as a reward or a kind of a trivial benefit in the new year instead, potentially? I know that's an extra cost, but it's not the fact that you'll be able to save national insurance because it may not be the case.
No, brilliant, Ian. Thank you ever so much. And one, finally, just trying to share the questions around for you, Pooja. What is the difference between annual investment allowance and full expensing besides leased assets?
Yeah, so the annual investment allowance has a £1 million limit across a group, so that's a difference, whereas full expense, it can be used limitlessly. And also the annual investment allowance can be used on assets that are leased across. So that's something that might be helpful where an asset is leased and they're not eligible for full expensing.
Brilliant. Thank you very much, Pooja. And probably one, I think, Sean, you're probably best placed to answer this one. Well, they've obviously talked about growth as part of this autumn statement and the growth of businesses and the growth of the economy. And one of that for those business owners that grow their businesses and then look to sell it. One of the questions is, are we going to retain entrepreneurs relief, now known as business asset disposal relief?
Yeah, so business asset disposal relief, or BADR, it has been severely curtailed in recent years, so it's not as beneficial as it once was, but it's certainly still here. And there has always been historically some form of preferential tax treatment when an individual comes to sell their business. The kind of logic or the motivation behind that is to try and encourage people to come to the UK and create and grow a business. So I think we can probably expect there to always be something there in some form or other. Both the Conservatives and Labour have talked about the need to reform it. As to what that might be and when that might come in is anyone's guess.
No, thank you, Sean. And staying with you, sorry for another question is, what update is there on removing Class 2 national insurance and Class 4 national insurance in terms of someone gaining benefits and state pension rights?
Yeah, so I think there was a question came in beforehand and two questions here. So hopefully I'm dealing with three birds with one stone here. So yes, for small unincorporated businesses, so we're talking about businesses with a profit of less than £6,725, they did have the option of making voluntary Class 2 contributions. And there was an announcement yesterday that those that option to continue those Class 2 voluntary contributions will remain where profits exceed that, and so they exceed 6,725 up to the personal allowance. Then the business owner will get credit for the Class 2 national insurance, but not have to pay it. So they do still count towards the state benefit. So yeah, I guess confirmed. That option to pay the voluntary Class 2 will remain open, and people will not have to move on to paying the voluntary Class 3, which is a higher cost in order to maintain their state pension entitlement.
Great, thank you, Sean. And Pooja, there's a fair few questions come in on R&D and the merge scheme and the changes from SME to the merge scheme. The two questions in particular that I've seen coming in relatively frequently are all around the potential restriction you mentioned around the fact that work or costs need to be incurred in the UK going forward, and that potential restriction. That's the first point. So do you want to answer that one first?
Yeah, I can do, Chris, but I'm just wondering whether you're best placed, because I don't know if Chris has been introduced as he's part of the national R&D team. So should I send that one back to you?
That wasn't part of the script, Pooja, but I'm more than happy to take it. So yeah, thank you for the question. In terms of the potential restrictions coming in from next April, currently any subcontracted expenditure that is performed anywhere in the world is eligible to be included within a UK R&D claim. What is happening from the 1st of April is that only that undertaken in the UK on UK shores will be eligible to be included on an R&D claim in the UK. Now, that said, there are some exceptions to that insofar as it was not actually practical to perform that work on the UK shore. For example, if we use a pharmaceutical company in this instance, where you need a certain patient population size in order to perform the trials and get the necessary results to get regulatory approval, then actually you might have to go further afield and actually perform a worldwide study to get that activity. So to the extent that you can't perform that work on the UK, you still will be able to include overseas expenditure in your claim, but that's something that will be by exception rather than the norm going forward. And likewise, the other one that has been asked is around the new R&D intensive businesses and the definition. And I know, Pooja, you mentioned in your categories around it's reduced from 40% of your total expenditure to be regarded as an R&D intensive business. That's been reduced down to 30%. So more businesses will now hopefully be regarded as R&D intensive and therefore benefit from the more preferential rates and benefits from the rates of an R&D claim going forward. That said, I with all of the perceived fraud and things that HMRC believe are going on in this place, hence the increase in scrutiny of R&D claims going forward, I can't help but think that reducing it to 30% might mean that more people try and just get over 30% to increase the value of their R&D claims. So it's a great idea, but I would watch this space because I wonder whether people will start to see whether they can creep over the 30% to get that extra benefit for those businesses. So watch this space from that regard. Brilliant. Just turning to, I think we've got time for one or two more questions. Probably coming back to you, Sean. Can we expect any response to the national insurance announcements in the Scottish budget?
Yeah, so just to, I guess, briefly set the scene. National insurance is a reserve power by Westminster. So anything that changes, any changes that Westminster makes to national insurance apply UK-wide, so to Scottish taxpayers, to Welsh taxpayers in Northern Ireland. What the Scottish government does have power over is some income tax raising powers. It's technically non-saving, non-dividend income. We'll call it earned income for the purposes of this. So the Scottish government has the power to change the rates and bands that apply to earned income, which will include self-employment income, employment income, but also rental income, income tax paid on pensions, and also discretionary distributions from trusts. Now they've obviously used that power over the years, and we have generally higher rates of income tax paid in Scotland for incomes in excess of £27,850. So the reductions in national insurance contributions will apply to Scottish taxpayers. It will be quite helpful to some Scottish taxpayers. In particular, there's quite a penal band where the Scottish higher income tax rate applies at about £43,666, but the lower rate for national insurance doesn't kick in to just over £50,000 because it's aligned with the English higher rate threshold. So for that 43,663 to £50,000, Scottish taxpayers actually suffer, or will suffer now going forward, a 52% effective tax rate compared to a 30% rate down in the rest of the UK. So it's quite a significant differential. It's quite a painful one for Scottish taxpayers as well. So in some respects, the national insurance changes are going to be welcomed north of the border. But what we do know is that prior to the autumn statement, the Deputy First Minister, Shona Robertson, did request the Chancellor not to make significant tax cuts. He's made them. They will be effective up here. So that's going to affect the amount of funds that come north of the border, and the SNP are going to have to try and balance the books again. What will that look like? We don't know. We'll find out in the Scottish budget on the 9th of December. We do know that previously the SNP have looked at the introduction of, in fact, a sixth income tax rate band of 44%. Will the reduction in NIC mean that they want to look at that a bit harder, or will that just create a further divergence from the rest of the UK and create disharmony based on that? So I think the question was, what's the reaction going to be following this? I don't know, but probably not good news.
Brilliant. Thank you very much, Sean. And I think just given time, I think that would be it for questions. But what I will say is if we haven't had time to answer your question today and you have typed the question into the box, then one of our team will follow up with you in due course, answering your questions directly to you. So we will get back to you shortly. So that's the end of the question and answers. What I would like to do is just to get as much value out of our panelists as possible is I would like to come to each of you in turn and just ask what you think the Chancellor could have included within the statement that wasn't included, or what you would like to see next. So if I come to you, Sean, first, that would be appreciated.
Okay, just very briefly, I did see one question which was along the lines of why am I mentioning 75 years old? The state pension rate age is not. 75 is a specific test applied to pension pots, not the retirement age, which leads into what I would have liked to see, and that is actually further clarity on the treatment of pension pots for individuals who did pass away before 75, because until we have that absolute certainty, it makes it very difficult to plan for an individual's estate.
Brilliant. Thank you very much, Sean. And Pooja?
So in terms of what I'd have liked to seen in the budget and what I would like to see in future, so I'd like to see full expensing available, whether assets are leased or hired, and if it's all intragroup, I think that should be okay, particularly if it's all within the UK. So I'd like to see some flexibility around that. I'd also like to see support for SME businesses, which are the backbone of the UK economy. So many of our clients, and not all SMEs, are making fraudulent R&D claims, and it's unfair to disadvantage all SMEs to reprimand a few. But finally, and probably most importantly, I would like to see a clear and significant commitment to net zero targets in tax policy. The UK funding towards net zero doesn't stack up when compared to the US, China, or the EU. So I'm hoping to see more funding in that area going forward.
Yes, it was definitely announced yesterday that they were saying sustainability and sustainable initiatives were definitely off the agenda. So hopefully they'll come in due course, Pooja.
Yeah.
And turning to you, Ian, from an employment tax perspective.
Keeping it very simple, I think a reduction in employer national insurance, as one of the questions has alluded to, would have been nice, but also a removal, and this links to what Sean spoke about earlier, in one of the cliff edges, that HICBIC charge, that higher income child benefit charge that you get from 50 grand, you know, it just causes it causes a lot of uncertainty. A lot of people don't realise they have to do tax returns potentially to sort that out, and it is a really nasty tax charge. And just very quickly, separately, I've been asked a question about pension salary sacrifice and how that aligns. The one thing I would say there is you need to check your eligibility, because national minimum wage has increased significantly. So anyone in a salary sacrifice scheme, are they still eligible? And obviously you may need to rebase the savings on 10% national insurance now from January going forward.
Great, thank you, Ian. And last but not least, George, is there anything further you want to add on the economy?
Look, I'm more concerned with debt levels. I'm more concerned with growth, and there is no easy fix. The more we spend, the more likely we'll see higher interest rates. So what I would like to see is measures that don't stoke inflation right now. I think that's the #1 enemy.
Great. And thank you from me to all of the panelists on the call. You've been great today, and thank you ever so much for your time, and thank you, George, for your insights at the end. And also thank you very much for all of you for joining us today. If you'd like to know more details about anything covered today or as part of the wider autumn statement announcements, please do get in contact with any of your Mazars contacts or via our website. Just to also let you know while we're on that we do also have a next webinar on our economies and investments, which is taking place on Wednesday next week. So that's Wednesday, the 29th of November at 10 a.m. The webinar will feature George. If you want to hear more about him, he will be on again next Wednesday. And also David Baker, he'll be joined by, who's our Chief Investment Officer and Head of Investments at the firm. And they'll be discussing global economy, inflation, interest rates, and the investment landscape. And a link to the register for that event will be put in the chat box immediately now, if not, it's already been put on. So that just leaves me to say thank you again very much for joining us today, and I hope you have a great rest of your day. Thank you, everyone.